Hey gang, one of the most common questions that I get is, Roger, should I trade the Dow, the S&P, or the Nasdaq? It's a good question, right? And I do get it all the time. I think my best friend just asked me that question just a few days ago. So these indices are highly correlated to another, but there's some major differences. Here's what you need to know and why it's so important to your trading right now. Which one should you trade? The answer may surprise you. Stay tuned. So, what happened when I asked this question to a good friend who's also one of the top traders that I respect? A guy who's been featured on CNBC, CNN, Forbes, Bloomberg, and Fox Business? Click the button at the bottom of this page to find out. It's a total game changer. What indices should you follow? What indices should you trade? Let's talk about all of this. Now, I'm going to give you a couple of different answers. I'm going to give you the answer that you probably want to hear, and then I'll give you my real answer from years of experience, okay? So, 3 indices. You have the S&P 500 follows the top 500 largest stocks separated into 10 groups. You got the electricity, you have technology, you have consumer sentiment, and others and others and others. You have 10. Now there's an 11th one, which is communication, but I just bundled that up with technology. So 10 major sectors within 500 stocks. So you figure each group, each sector, like utilities has about 50 stocks on average. So altogether, you got 500 stocks, very well broad-based index. But the only caveat is you've got the 500 biggest capitalized stocks. That's the S&P 500. Then you have the Dow Jones. What is the Dow Jones? It's the top 30 blue chip stocks. You could say defensive stocks. You could say there's a lot of ways to characterize it, but the best way I know is it's 30 of the top blue chip stocks. Stocks that most investment bankers, IRA accounts, pension funds utilize in their portfolio. So the liquidity is great, but there's only 30 of them. And then finally, you have the Nasdaq 100. What's the Nasdaq 100? Well, it's similar to the S&P 500, but instead of having 500 of the biggest stocks, you have 100 of the biggest tech stocks. Now, they're not all necessarily totally tech. Some are broad-based, meaning there's some consumer discretionary stocks like Amazon, for example, and also most, I believe all of these stocks, or most or all of, I think all of these stocks, but don't quote me on that, are also in the S&P 500. So the Nasdaq 100, if you will, is a segment of the S&P 500, one that has the technology aspect or stocks related to technology or growth. So the question now becomes, which one should you trade? Well, logically speaking, if you have a portfolio or you're tracking blue chip stocks, then the obvious choice would be the Dow Jones. If you have a portfolio or if you're tracking the broad market, the large cap market that has all the stocks, then you're looking at the S&P 500. Or if you're hedging a portfolio, the S&P 500 is a good bet too because it has the most well-rounded base of stocks, which gives you that diversification. And then if you have tech stocks or if you're interested in tech stocks, growth stocks like Apple, Amazon, Facebook, then the Nasdaq 100 is your best friend. Now, I have a friend, a really good friend of mine, and he asked me many years ago, Roger, I just want to put my money in one and I don't want to do anything with it. I just want to leave it there. So there's a lot of different answers. So let me answer this question for you. What are you looking for? Are you looking for the least volatility? Are you looking to hold short term? Are you looking to buy and hold for the next 10 years, which is what my buddy did, I believe 10, 11 years. So it depends. It depends what you're trying to accomplish. Let me explain this to you. Over time, the correlation between the S&P, the Dow Jones, and the Nasdaq 100, I don't know why I can't speak, is probably close to about 95%, which means if one goes up over time, the other one's going to go over time. If one crashes, and I mean crashes, the other one's going to crash. Day to day, they may see fluctuations, but over time, they trade in one direction. But here's the big difference. Volatility. Volatility is very different between them. For example, the Nasdaq 100 has the most volatility, And because it has the most volatility, it has the most trading range. And because it has the most trading range, it'll give you the most exposure over time. Whereas if you're trading the S&P 500, it's got 500 stocks, and it has bank stocks, it's got industrial stocks, consumer stocks, it's got all these different stocks. So it'll give you less volatility. So again, it just depends on what your tolerance for volatility is and how long you're going to be holding. So my answer, my personal answer, and I know I'm going to get a lot of emails and people saying, no, Roger, you're being a cowboy, but here's what I believe. I would just put my money, if I'm just going to buy and hold for a long time and just forget about the market, why not put your money in the Nasdaq 100? It's got the most volatility. So yes, your investment will go up and down more, but over time, it'll give you the most appreciation. And since it has the correlation with the S&P and the Dow, ultimately, they're going to end up in the same place. But the trajectory of the Nasdaq is that much stronger. It has a volatility of about 1.5 times that of the S&P 500. So if the S&P 500, for example, I'm pulling this out of my head, but out of thin air, if the S&P 500 gives you 50% return over 5 years, let's just say, the Nasdaq 100 will give you 75 or 100% return. Now, I know the volatility will be greater too, but you're not liquidating. You're just holding on. All right? So again, if you're looking for short-term trades, you should match it with your other investments. Blue chips, the Dow, overall market, S&P 500, technology, Nasdaq 100. But if you're going to hold this thing for a long time, just go with the one that gives you the most bang for the buck. The S&P 500 is not going to go bankrupt. Either will the Nasdaq 100. Either will the Dow. But why not go with the most volatility? It'll give you maybe a little bit more heartburn, but at the end of a 3 or a 5 year period, you're going to see a lot more money. Hope that helps. Folks, a word to the wise. A golden rule to follow here. Don't trade any of these assets unless you have an ironclad hedge in place. You need a diverse set of positions that don't move lockstep with the overall market. So no matter what tweet the president sends or what the Fed does, these trades won't move in the same direction as your other investments and assets. What's your best hedge option? Click the button below. Find out right now. Without it, your portfolio's in serious jeopardy. You can't overlook this. Click the button below now. Make sure you're protected.